So in yesterday's video, the average person is very poor. At the end, I provided some initial guidance what can be done over with the following problems, and I basically pointed out 3 ways to enhance the performance and to get a much better portfolio return. Like this portfolio return over 20 years, where just the math suggests that having a higher savings rate at a higher annualized return of 15%, or using a starting point like a 120k salary, would return in a $3 million nest egg. And these variables seemed unrealistic for some people, so I thought, okay, let's dive at least into one variable that was pointed out by some people watching the video. And this is go from a 5% safe investment yield to 15%. And I will show you something that I just did, like backtesting analysis with ChatGPT. I have been investing for the last 10 years, so this is more or less my experience. I did not use this exact strategy, but I just wanted to show how this kind of strategy performed. It's just a backtesting of a random strategy. Okay, the idea was simple. For each year, I found out the stocks with the biggest market caps, right? And for instance, you can just Google it, like biggest market cap stocks 2014, for instance, and you can see in 2014. Here you can actually check out this the Wikipedia article, and here for each year they have listed the stocks with the biggest market cap. Let's go to 2014, 2016, 2015, 2014. 13, 14. Okay, so these one are the companies in the first quarter. So say you do one investment decision every year, you would invest into Apple, ExxonMobil, Microsoft, Google, and Berkshire Hathaway. So these were the 5 companies with the highest market capitalization. 3 of those 5 are still in the top 5, right? Berkshire Hathaway not, and ExxonMobil not. They have dropped out, and others have come into the top 5. But 3 of those 5, Apple, Microsoft, Google, are still there, right? So it was not a bad strategy. And in the winner takes most market, we are, with considering AI, considering computing, digitization of everything, in the winner takes most industry that we are currently now, I think this is a sensible strategy, right? Investing each year into the top 5 companies by market cap, and usually those are very successful companies. By definition, these are the most successful companies out there, right? And so I just wanted to backtest this strategy. So we assume that you have a 20% savings rate. I don't even assume that you make a 120k salary. I assume you make say, or somebody that actually took this strategy would have, say, a 25% savings rate on a 60,000-70,000 salary, right? So you would invest 10k every year. So it's less than 1k a month. It is definitely possible to do this even with a normal income. But if you have a above average income, then it's definitely doable. Okay, so let's go into this. First of all, I figured out the data. These are the stock prices over 10 years. So in each column we have the stock prices. For instance, in the year 2014, the Apple stock price was $20. In the year 2024, Apple stock price, it was $187, and this is like in the beginning of the year. And then as the expected stock price for 2025, I just used the current stock price in July 2024 as a proxy, because we don't have the 2025 data yet. Similarly for Nvidia, split adjusted, the stock price in 2014 was 0.37. So this was not a top 5 market cap stock, so you wouldn't have invested into Nvidia back then. And but today, the stock price is 126, and I think from 2024 on, it was one of the top 5 stocks, right? Yeah, even in 2023, it was one of the top 5 stocks by market cap. Okay, so this is a basic idea. So we have the biggest market cap stocks. I gave them here in the last column. We have all the stock data extracted from the relevant stocks. Basically, you would invest into these kind of companies: Apple, Microsoft, Google, Amazon, Meta, Berkshire, ExxonMobil, Nvidia, Alibaba, Tencent, Tesla. That's it. So these were the companies you would have invested into in the last 10 years in this backtesting strategy. And then I thought, okay, what is a good overall strategy? Of course, you could invest only into the top 5 companies and rebalance, like sell every year your position from the last year and then buy back like 20% for each stock of your portfolio, buy back into the new stock. But this is not the strategy I chose. Why? Because of tax inefficiency and because of trading inefficiency, right? Buying and selling incurs costs. So you have some transaction costs if you buy and if you sell stocks, and also you have some tax loss, basically. So you would pay capital gains tax if your stock goes from 20 to 27. You actually have made like 30% gains or so, and of those 30%, 1/4 of it would have to be paid as tax, but only if you sell the stock. If you hold the stock, it wouldn't be taxed, right? So there's no tax liability if you just buy and hold. That's why successful investors usually employ buy and hold strategies where they hold positions for a long period of time and let the compounding do its thing, right? And usually, as those are very successful companies, they compound very well, right? You see, Apple, the Apple market cap was like 478 billion in 2014, and then they have just compounded capital from 407 billion, still being one of the top stocks, to 2.6 trillion in 24, and even higher, like even in the second quarter, to compounding their value to 3.2 trillion. So they have made like a 6x or so, right, in this 10 years. So that's why this strategy is, I think, it's a reasonable strategy. You would never sell anything. You just accumulate positions every single year. You put a portion of your paycheck into it. We use 10K per year. Of course, if you can only add half, then you would divide the resulting numbers by half, and you would just buy and hold, basically, the positions. Very simple strategy. And now the question is, would it have outperformed the S&P 500? So I put this data, I downloaded the CSV, I put it into ChatGPT 4.0, and then I gave it the following prompt. So I have given data with yearly stock prices of some of the biggest companies, and I explained what I wanted. I asked it to backtest the following strategy: invest 2,000 each year into each of the top 5 stocks by market cap, given in the last column I have just showed you, at the given prices. And then we just simply accumulate the positions and we never sell. And I wanted to have the portfolio value over time and some additional information. Okay, so let's have a look. Here you will see, first it gives the spreadsheet. In the year 2014, the total portfolio value would be 10K, right? And the Apple position would be 2K. We would also have bought ExxonMobil, Microsoft, Google, Berkshire. So these were the companies we would hold, right? And then next year, 2015, actually the total portfolio value would have more than doubled. Why? Because we added 10K, right? And then we also have had some compounding. So the Apple value now went from 2,000 to 4,700, because in the second year we also accumulated more Apple shares. Apple was still one of the top 5 companies by market cap, and also Apple grew by 20-30% or so. So that's why our Apple position now is already 4,700 in the second year, and we would accumulate basically the same positions, right? And then in the fourth year, a new company, Amazon, would enter the top 5, and we would accumulate Amazon, right? And so on. So we just continue to do this. We keep positions, so the number of positions in our portfolio keeps rising, but we only accumulate positions as they so new positions if they remain in the top 5, right? If they drop out, we don't buy new shares. So we don't buy the losers. We are not buying the losers. We are only buying the winners. And if a company keeps winning, we buy it every single year as long as it keeps winning. And I think this is a reasonable strategy, right? Only focus on the winners, and the winner takes most. Environment, this is like one of the best strategies you can do. Very simple strategy, but I like those kind of simple strategies. So the portfolio allocation in 2025, so in the last years, would be this one, right? So you would have high concentration into a very safe and big winners. For instance, Apple, 28% Apple, 28% Microsoft, 20% Google. So this would be a position I would be very comfortable in. And 1.3% ExxonMobil, 3.4% Berkshire Hathaway, and then we also have a 10% Amazon share, Nvidia 6%. Why only 6%? Because we only started accumulating Nvidia when it enters the top 5, right, in this strategy. And we only accumulated it for 2 years or so. We didn't do much accumulation because Nvidia has not been in the top 5 for a long period of time. And then we have some smaller positions like Meta, Tesla, and so on, right? Here, this gives the total portfolio value over time. And you can see this impressive performance of this very basic, only 10-year strategy. I mean, if you add 10 more years to the strategy, we would be in the many millions of USD, right? Probability adjusted. And but in only a decade following this strategy would have resulted in a portfolio of $424,000 right? And we only put in 10K every single year for 10 years. So we put in 100K, we would make 424K. So this would be the portfolio value. So we would make 324K just from the investments. And we would be more or less financially independent, right? If we can live in a smaller, maybe a cheaper country or so, could be possible to live from this portfolio value after 10 short years. Now let's look at the individual stock values over time. You see that we keep compounding the winners. This is basically a strategy here. The individual stock values over time, like Apple has been in the index for all the time. So we both purchase more Apple stock. Apple is here, the yellow chart. We purchase more Apple stock and we also let it compound. So if the stock price increases, we just let it increase and don't do any rebalancing. Don't sell any position, right? We don't sell any position. So we have no tax loss. We have no transaction loss. It's just a very passive buy and hold strategy. Very simple, but I would say much more successful than index fund investment or so. Then we have, because in the index fund you also buy the losers, right? And you keep rebuying the losers basically. And in my opinion, this is not a good strategy. It's just like also an index fund is also an algorithm, right? It's not like an index fund is inherently better algorithm than this algorithm I provided here, right? It's not like there's no first principles reason to think this. Index fund. So I think there's some minor issues because the smaller positions here have not been updated in this chart. So I could iterate now, but it would be more or less the same, right? It was like these smaller 2K positions. They are basically irrelevant for the overall portfolio value. Okay, so strategy is invest 2,000 every year into top 5 stocks by market cap and hold the position without selling. I have not seen this basic accumulation, buying and holding strategy anywhere, but I think it will be much more successful. So now, historically, the annualized return, compound annual growth rate of this portfolio is 40.59%. Of course, it's not investment advice. It is not a guarantee that this will hold in the future as well. And also, I think this number is wrong a bit, and I have done some math on this. Let me show you. Here I show, like, I have very small like spreadsheet. Here I assume 30% return. I start with 10K and I add 10K every single year for 10 years. So we add 10K for 10 years. So the sum is 100K, and our portfolio is we track the portfolio as the sum of the previous portfolio multiplied with the growth rate from the investment return plus the 10K we add to the portfolio, right? So this is now our total portfolio would grow like this, from 10K to 23K to 39K and so on. And now we can adjust, we can modify this return value. So for instance, if we would have a 10% return, this is like the S&P 500. If you would have an S&P 500, then our portfolio would grow from 10K to 159K. And we would have invested 100K for 10 years. Sorry about that. So we would have made 59K in 10 years. not too impressive, right? So this would be the S&P 500. But now if you go to 20% annualized return, our portfolio would grow to 259K. If we would go to 30% return, our portfolio would grow to 426K. And this is roughly the end value of our portfolio, 424K, right? 424K and 426K. So it's roughly the same. So our compound annual growth rate actually would be 30%. So ChatGPT did some mistakes in this line, in this calculation. But I confirmed that I figured out the mistake as well. Okay, so this simple strategy roughly has given a 30% compound annual growth rate. I don't see any reason why it should not continue this strategy, because these winner stocks will keep winning. They are not too overvalued. Like many of them don't have too high of PE ratios. Of course, there will be volatility, right? Many positions here have been reduced. There was not a major bear market like 2008 kind of crisis in these 10 years, so it's kind of it might be biased. But anyway, I would be more comfortable with such a strategy, such a buy and hold strategy, because even in an index fund algorithm, so you proportionally weigh your allocation to stocks to the percentage in the index fund, to the percentage market cap of the overall market cap. So this is also just an algorithm, and this algorithm incurs a lot more transaction overhead. So you need to buy and hold and readjust and rebalance the weights, and usually you rebalance toward the companies. Like a large portion of the companies are basically the companies at the bottom, like less successful, less good companies. And in the world of AI, the winner takes all economies are really strong. So companies that can actually afford big computing cluster, for instance, like Meta, Apple, Google, Microsoft, will keep winning and winning faster and faster because they have access to all the intelligence needed to scale up the company. So I think it's a reasonable strategy. I'll follow a similar strategy, a bit more loose, right? Not as rigorous, but I thought, okay, maybe sharing this backtesting portfolio allocation strategy can be fun for some people. Good. So now and this pie chart here, especially like after you see, it's usually you have an 80-20 relationship of the stocks in the portfolio. So if you let the stocks ride for a longer period of time, like 10 years or so, usually you get such an 80-20 distribution or Pareto distribution, where a minority of positions make up a majority of your portfolio. But this is just you have let the winners ride. You let the winners ride, and you don't cut the flowers. You basically don't cut anything, right? So you let the flowers bloom, basically. And here we have, if we always buy the top companies in the world, some of them will 10x, right? And this can then overcompensate all of our last losses if we had any. But usually we didn't have any losses, right? Because all those companies actually did pretty well. Like even the worst company, like ExxonMobil, did not so badly, right? Like here, if you look at the positions again, we have ExxonMobil going from 63 to 100, which is not so impressive in 10 years, but at least we wouldn't have lost a lot, right? Here Microsoft from 36 to 400 is like a 10x. Google 27 to 185. It's not a 10x, but a 5, 6, 7x or so. Amazon from 19 to 190, 10x. Berkshire did not as greatly because it was already a big company, from 117 to like 400 or something. So especially as we have change, this would actually benefit our company, because change would mean we have more players like Nvidia that would actually lead to massive gains in short periods of time. And as they enter the top 5, they would quickly then rise to the top and create huge amounts of gains. So volatility and change dynamics is not too bad for this kind of strategy. Okay, so one last thing. I thought, okay, just for fun, I'll ask ChatGPT to provide us some advantages of such a portfolio. And as I said, one of the major advantages is tax efficiency. We have deferred capital gains. So we have a lot of capital gains, right? Our positions grew, but the strategy involves never selling the stock. So we are just accumulating. We never realize any capital gains, so we never pay any taxes on this position. We can maybe take a loan against the position or so you can use, like some brokers, most brokers provide ways to take loans against the position. We can take small loans to live off the position, to never pay taxes, basically. The long-term growth potential of this would be, we are exposed to market leaders, right? This strategy focuses on top market cap stocks. And these are market leaders with strong business models, financial stability, and significant competitive advantages. It's difficult to win against those companies, especially in the in an environment of AI domination. We have no trading fees, right? We just buy stocks and hold them. No trading fees. We can use free brokers or so, where we can just hold stocks over long periods of time. Not paying any management fees like in ETFs or so. We just keep the positions, keep them growing and compounding the returns of those. We would have some dividends. We could maybe decide to live off the dividends. Those dividends would have to be taxed, but the dividends would be usually not a big portion. Why? Because the biggest companies usually have ways to reinvest capital efficiently. So for instance, Apple doesn't pay out huge dividends. They repurchase their own stocks, which is also a way to give back to shareholders, but more tax efficient ways. So we can keep compounding our returns. It's very simple, very low maintenance. We just have to look up the market cap once a year and buy the stocks from what we have saved in this year. We have diversification, right? Even if one company completely fails, in our portfolio, we still have the other ones, right? So even if, say, one position here, so say our biggest position, Apple, now loses, basically, or fails, maybe goes bankrupt even, if I think it's almost impossible probability-wise, but okay, say Apple goes bankrupt, okay, you lose 28% of your portfolio, but so what? I mean, if you are investing in an all stocks portfolio, 28%, it's just something that can happen all the time. And usually it will be then compensated by gains in other positions. We have an inflation hedge, because they grow faster than inflation. We have market, we are dynamic, like we shift to changing environments. As new market trends evolve, we are basically investing in them, right? Because new market trends bring up new companies. In NVIDIA is a good example, and we just keep buying more NVIDIA as it goes into the top 5 market cap, for instance. We don't have too many stocks. We only have 5, right? We don't have 10 or 20 or so. So maintenance overhead is pretty minimal. We have some behavioral advantages, no emotional trading or something. Just buy and hold, very simple. You can sleep at night. You don't have to do any emotional decisions. There's some dividend income. Okay, I don't see this as a big advantage. And it also says we capitalize on market efficiency by investing in the largest companies by market cap. The strategy leverages the idea that market prices reflect all available information. I don't think this is very relevant. I don't think the markets are efficient. Okay, so I think it's a good strategy. I want to show this. If you like this kind of video, give me a like, subscribe. If you want to learn how to create an income, create a career in AI or in post-AI world, then check out the Finxter Academy. You can just go to academy.finxter.com, finxter.com, and or search Google for Finxter Academy, and you will land here. This is, so we have many courses, like how to use the Gemini Google API for AI engineers, how to use Hugging Face, how to run free and open source large language models to generate text, images, speech, and music on the local machine, how to create multi-agent teams and systems. This is important if you want to create automated companies or organizations, how you can fine-tune your AIs, how you can build generative AI apps, also with Google's Vertex AI and LangChain. These are kind of, it all sounds fancy, but it's really simple. Most people can become an AI engineer because it is just about using the API. It's about using the AI. It's not about programming the AI or having in-depth AI knowledge or so. You just need to use it to create applications, and everybody can use it, right? Everybody can use Google, everybody can use ChatGPT, everybody can use Python and the OpenAI API or the Google Gemini API or Hugging Face. It's pretty simple stuff, I would say, but it gives you this infinite leverage that is so much sought after in today's marketplace. So check out the Thinkster Academy as well. Give me a like and subscribe to the channel. We have videos like this usually every day, sometimes at least multiple times per week. I try to keep pushing forward to help you be on the right side of change. I think the need is huge because the environment changes so rapidly. And yeah, this kind of backtesting, I thought it was fun. So I enjoyed the process of just analyzing it with ChatGPT. Hopefully you learned something out of it, and yeah, you could think about implementing something of this. No financial advice. Thanks for being here, and see you in the next video. Bye.